How does an angel investor evaluate a startup before investing? In recent days, the world of startup funding has been buzzing with activity. Many aspiring entrepreneurs are eager to know how angel investors decide where to put their money. If you are a startup founder or simply curious about the investment process, you are in the right place. Let's break down how angel investors evaluate startups before making investment decisions. Angel investors typically assess startups through a mix of qualitative and quantitative factors. One of the first things they look at is the quality of the founder and their team. Investors want to see a founder with relevant experience and skills. They also value commitment and resilience, which are vital in the early stages of a business. Strong leadership qualities often indicate a higher chance of success. Next, the market opportunity is a significant factor. Investors analyze the size and growth potential of the target market. A startup that addresses a large or rapidly expanding market is often more appealing. The problem the startup aims to solve should be meaningful, and the solution must be scalable. The product or service offered is another critical area of evaluation. Investors examine how unique and innovative the offering is. A clear value proposition is essential, and having initial traction, like a prototype or early customers, can strengthen the case for investment. Moving on, the business model and revenue potential are scrutinized. Investors want to see a clear path to profitability or sustainable growth. They analyze how the startup plans to generate revenue, including pricing strategy and customer acquisition costs. Understanding the competitive landscape is also vital. Investors assess how the startup differentiates itself from competitors. They look for barriers to entry and intellectual property that can provide a competitive advantage. Financials and valuation are key components of the evaluation process. Even early-stage startups may have limited financial history, but investors review financial projections and cash flow needs. A reasonable valuation that aligns with the associated risks is crucial for attracting angel investment. Legal and operational readiness cannot be overlooked. Investors often check if the startup has a proper legal structure and compliance in place. Clear documentation and operational readiness help reduce investment risks. The due diligence process is where the evaluation becomes more thorough. Investors verify claims, review contracts, and assess potential risks. Some investors use structured tools or checklists to ensure they cover all bases. Lastly, technology and data play a role in the evaluation. Some investors apply data-driven tools or artificial intelligence to filter startups based on specific criteria. However, human judgment remains essential for assessing qualitative factors like the founder's character and vision. In summary, angel investors combine their assessment of the founding team, market potential, product viability, business model, competitive edge, financials, and legal readiness to make informed investment decisions. The founder's ability to execute and adapt is central to their evaluation.